Welcome to this video in how to trade double tops, double bottoms the correct way. What you see in front of you is 4 different charts, 4 different time frames. It's the monthly, the weekly, the daily, and the 4-hour, or the 240 minutes that you see here. The monthly we use to find a top and a bottom, so we know that our target should never exceed that levels, simply because if we're trying to take targets above the highest ever or the lowest ever past 10, 11 years is what I can see here, we put ourselves in too much risk. It's very rare that it happens, but let's say you were trading up here and the target was up here, chances for you to reach it is slim, right? So that's just your chart for seeing, okay, this is within the range of the top and the bottoms of all time. The weekly will have these setups. They will take time simply because each candle takes 1 week, 7 days. And the daily and the 4-hour, the main focus is daily really, because that's my totally favorite. It's very simple to do, because if you have a day job or if you have any other business run, you just check them once a day. That's all you have to do. So the logic behind the system is simply this. It has to be the highest top recently or the lowest bottom recently. And then it has to retest that bottom or top one time. Like here's the bottom. You see, this is the lowest, most recent, right? And then it goes up, make a high. A high is formed when there are 2 candles to the left, 2 to the right. So it's a 5 candlestick setup with closed candles. Must be between these touches. So for example, this one and this one is not double top, but this one and this one is, because they have a low between them, right? Important to understand that. Okay. So what we do now is when we have this bottom, then we have a high, and then we have a low. So low, high, low for buying situation. To illustrate this better, we call them M and W patterns. The W is basically, we start from here down to here. Drag the next leg, which is from bottom up to the top of the high. Next leg is from top, high, down to the next wick. As you can see, you don't have to be concerned about entering at this retest or so on. It's just, you need this structured setup, a W, this, and then we have this one, right? So that's a double wheel formation. What you will have when you enter, you will pretty much have it like this, simply because you don't know this yet. So when you see this, let me remember this W here. It's important that you have the W, because if you don't have a high in between, you will never get a W, or you will not get an M for sell. So now here comes the things that is really powerful. When you normally trade these patterns, you will learn that if you enter on like a double bottom, you should be looking for the next resistance there and there for your target. So it will be there pretty much. And you're risking, by sitting down here, you're risking quite a bit if you don't have a system for this. Simply because when it's down here and you don't have any candlestick patterns or anything, you don't really know if this is just a bottom or a test of a bottom, then for pulling further down, right? That's why we want this high, that we want these W patterns to form. And this level here is super, super important, because when this is broken with a closed candle body, very important, can't be weak, must be the thicker body closing above this level. We know that the market will come down at least one more time, say hello to one of these wicks, or in best case this one, before it starts to move up to the next resistance. So when you have your double V formation, you have a market that comes up and close above your high. Then you can put in an order to enter at this level, in this case 97.57, right? Or at the wicks, we will do like this there, So we put one entry here, which is the best one. And then we go also to the first wick, which is there. Because every time a market break a resistance or break a support, it will come back, say hello one more time, minimum, at least one more time. Most days do it several times. You see in this case, it goes above here, goes up or down. We don't know that yet because this took one day. We don't know what it did first, but we know it went down here to say hello to this that we broke the previous candle one more time before up. So that's great. We have a system for entry, but we don't have a system for exit or how far we should stay in. Simply because when you're entering here, you do have a stop loss below here or what you can afford. And therefore you would like to have a good money management for exit. If you're entering up here, just clean entry up here, you would go for this normally when you trade. And the pips you will make here is really not enough to cover these losses if you come into a bad week or bad month. But here is the key to the system. You take a tool or you measure manually. You take the absolute bottom, the lowest wick of these two. You drag it up to this wick, which is our high there. You see that's 205 pips. The last one is a pipette. It's not counted for 205. When you have that, you can click anywhere on this one and move this and move it up to this wick. Okay. So as you can see, it perfectly hit this range, 205 pips. You can test on others, it will work just fine on most of them, right? And the reason this is working, I'll try to explain it in a simple way, is simply because this is called the AB range, which is 100%. If you are familiar with Fibonacci, you know what that is. And the targets that you will be looking for on Fibonacci is normally the 100 plus the retracement added to the top upwards. So if this market retraces 61.8%, which is the golden ratio number, then you know the market will predominantly mow this range plus the retrace. So it will mow this retrace above this one, right? And if you take this level here, this is Fibonacci trading, not this system, but if you were doing it, that range, many times it will or will not reach it. But it's a very good estimate to how far it will go. So in the next wave, you see it's also a resistance here. The next wave, it will probably go there. But by doing this simpler way, to measure the high to the absolute low of these two double bottoms, you know a better range, you know a better target, because it will hit that many more times, because it's normally 127% out of this ABCD wave. But you don't need to understand the ABCD wave. Right? So let's see if we can find something more. Here we have. And the more time it takes, the larger the profit will be. That's how it works. So we come up here, nothing. We come up here, nothing really. It drop back, drop up, doesn't reach this one. Drop down to here, drop up to here, right? Now we have again a double top. So you have this wick is right on the candle there, the body top. You should try to avoid when this wick is taken out by a higher body, because they have more risk. But normally, many times they will work, but just a word of caution there. Watch out if this body high, this wick high, and has a body on the second test that is higher than this one. Watch out, because this normally means it can break it and it can go further up. And since this is a reversal pattern, we just want this to happen here, happen again, and then fall. And so on this one, when we have a top here, we have a top there. So we once again look for an M pattern, and we really don't have to draw M until this this low has created. This is a high, this is a high, this is a low. It's opposite to the previous order. So when this is created, market moving up, make this second. Now we can say, okay, if this is an M, right, we know that one leg would be there. We know that one leg will be there, right? And the legs between the base, I call it the base where it started. For example, this start of M cannot be here because this one can never be lower than the base start. And the base is the first leg. So the first leg, we go down to some major support here. When we are here, we don't have it yet because this is lower. So this is the start of the M. Therefore, you don't have to draw this until pretty much all the pattern is done, right? And then this one, you don't know. So put it there because you don't know. You know when it's coming down to like there you know, right? Because if this level, this is the level you must close below at the body. See how it supported, touched it. This is not a right entry. This is a right entry, right? See how this one pull closes below this body's close, and then coming up 1, 2, 3, 4 times it tested this level. This was not long range between the close below and the test, but sometimes they are, and you must wait. But in this case, you can just enter it because it's just maybe 20 pips between these and these, right? Right. So now what do? You calculate where should I exit this position. And you take the highest of this trade to the body there, and that's 382 pips, and a lot of pips to be made, right? And then you must move this one to like there. You see something magical happen exactly where it went. Exactly where. And this is common simply because this is mathematics. The retracement here is equal the length that will move down one more time. Okay? So that was also CAD on the daily, how to use this system. Sometimes it can be hard to know if this is a recent low. If it is after a high, then it is the recent low. You can't compare this one with this one, simply because if you have this high up here, and then it comes, this is the lowest, and this one is higher than this one, and then this one is higher than this one, right? So here you have actually a lot of opportunities, right? But when you come down here, you see that you have bottom, went up, made a high, come down, and made a low really. And this one could be it, but it tested 1 or 2 more times before it even tried to close above here. And then you see how it closed above this high there, come down and test this level many times before anything happened. So now you know how that works, but we're going to go through it as if it was the first time again. And take the arrows. So basically you have a bottom, you have a high, and you have 2 lows, right? So this is the first leg, this is the leg up to the high, this is back down to the lowest of these second tests, because there are several of them, but remember, take the lowest. It really doesn't matter in this case because you're going to measure between this one and this one anyways later on. And then this is your potential last leg of your W. Right. So if you get this visually, it's much easier for you to understand how simple this is. And remember, it takes a day for this one to close, so you don't have to panic. You must wait until it closes, and you must wait until it closes about here with its body, not a wick. Here's a wick up here. It means price couldn't hold it, pulled back to here, close below it. It's not an entry, right? Very important. So this is the level we must reach, and we reach it here. And pretty much here I would enter, and then I will re-enter when it's come back down and test this 1, 2, 3, 4, 5 times, right? And now what you do, you measure the lowest bottom to the high. That's your take profit, right? You should remove the spread and maybe 1-2 pips, because this is normally exactly where it will go. So you don't hit it and won't close the order simply because you missed the spread. Spread is the difference between buy and sell. Okay, so now we move our box to here, and you see this 2.9, which is 209 pips in Aussie dollar, Japanese yen, which is a lot for such simple way to find it. And you come up here. It went higher, but you don't care about that simply because you're trading your system, and your system is to leave when it do the double size of this bottom to top. Okay, let's take one that probably has not worked out yet. I don't know if it has, but we try this one. You see, there we have a high, there we have a high, there we have a low. There is a low in between these two. Both the highs are part of, or this one is part of this low, because a low is formed by 2 to the left and 2 to the right with a center candle low. Alright, so again, this is our M leg. Remember, it's M leg when you sell, and it's W when you buy. So again, we're up here. We know this now. This is low, this is high, this is high. We should measure the bottom of this low up to our highest top here. Or actually, you should measure. I do this because it's many times it can be really the difference. If you don't use the spread and a few pips removed from your box, it will it goes this range and you miss it by 1 pip. So therefore I don't use the wicks really, I use this one. Sometimes I also stay in trade longer than this box, but this is the simplest way to do it. You see here it's 176 pips. You see, if you do this 176, 200 pips, 200 pips, 200 pips in all these trades, there's nothing that will stop you from increasing your account. So, okay, so now when you're here, you take this box. Let's see if it is worked out. Oh, it was easy. I thought it was not doing that. And you see how it went down and touched that level, closed on that level, and it was apparently a tough level because it's probably a Fibonacci number or mathematical number at least, and that's how it works. And you see here that when it closed below here, it come back up 1, 2, and 3 times to hit this body open price or the bottom of this body. It do that normally, so don't enter down here unless it's very tight to this low. Let it come up, because the market do that. See, when it break the high here, come back testing. When it break the high here, it come back down testing. And when it break this low here, it come back up testing, even around a bit higher before it's dropping. Break this low here, come back up testing. We want it there, and it goes there. It's fine. We are in, right? And if we were wave trading, and this break this one, we break it here. Come back one more time, say hello. That's how it works. It's break, I'll say hello, break, say hello, and that's what we use with this system. It's simple as that. What you see here is Australian dollar, Japanese yen. This is an ongoing trade that is not yet activated. Top, top, low. It closed this Friday, the 2nd February 2018. After the non-farm payroll, this one happened, or unemployment data. I don't know what caused it to drop really, but the yen gets stronger in this case, and it helped the Aussie yen when the dollar changes, right? But we don't go to speculate how this works, because we don't really care much about it. We care about the pips moving, that's all we care about. So, we'll move this one. If you see these two, you see this is a bear candle, price open here, closes here. This is a bull candle, price open here and closes there. So this means this should be probably the lowest. I think they are pretty equal. It doesn't matter, we can take this line there. So 83, 87, 38 or so, right? So expect this one to go up, say hello to this level at least one more time. It'll probably go a bit higher, maybe go up there. We don't really care, because our stop will be up here or up here if we can afford it. Remember, the longer it trades, the more pips down and the higher stop loss. Take 1/3 of your stop loss or half of your profit, your stop loss, because you will win these ones a lot more than you lose them. So don't set the stops too tight, because then you will probably get stopped out, because many times we go up and test this level one more time. The next resistance from will at bottom here. Very important, right? But if you do this, you have a simple system to gain a lot more pips than most traders can do. So thank you for listening, and I hope you enjoyed this video. Bye for now.